ready, I'm going to go ahead and get us started. And while I'm speaking, Greg will help us bring anybody else in who's coming. And then I will take over again and we will run our panel. So I'd like to officially welcome all of you to the Succession Planning Roundtable. As most of you know, my name is Abby Donnelly, and I founded this organization, the Succession Planning Roundtable, about 6 or 7 years ago. And the idea is that we come together 2 to 4 times a year, and we talk about topics that are relevant for financial service professionals in the area of succession planning and exit. Our events are often run by experts from our chapter, which I really like, and today is no exception to that. The events are free and open to anyone. So for those of you that have clients that you think might benefit from future programs, they're welcome. There is no cost to attend, and we like to include whoever's going to get value out of this. So when we meet in person, most of you probably know, because you've been to many of these before, I like to do some introductions. And it's a little bit awkward when you're doing it on Zoom because it's hard to kind of go around the room and make sure you get everybody. So what we thought we might do today is invite you to introduce yourself by putting your name, your role, the company that you work with, and your favorite football team. That was a nice ad from Julianne, your favorite football team in the chat. And when I see the chat coming up, I'll go ahead and recognize you, and then you can wave to everyone if you want, or you can unmute yourself and say, hello, everyone, or something like that. And if you're on a phone and you can't do a chat, then at the end, I'll ask if there's anybody else that wants to do a brief intro. And I'm looking at the screen, and I think we might be able to go ahead and do actual introductions because we don't have so many that we've got multiple screens, but I see chats are coming up. So let's see, we will start with Paula McMillan.
So sorry, can someone teach me how to go to the next line in Zoom without this sending?
Just keep typing.
Just keep typing, it goes to the next line. Thank you, Greg. Greg is the expert. Paula McMillan, Wealth Advisor, Stearns Financial Group. I don't know anything about football, so.
Thanks, Paula.
Thanks, Abby.
All right, Julianne.
I'm at the Community Foundation working in planned giving with a CPA background. And for some reason, I don't like football either, but I like Seattle Seahawks because I like the quarterback. Because he was at NC State.
All right, thanks. Greg.
Yep. Hey, I'm Greg Schlaudecker. I've got a couple of hats. I'm the chapter executive for the Greensboro chapter of SSFP. Nobody can say that, right? And I'm also the principal for Emerald College Planning, and I help college-bound families pay less for college. Favorite football team? I don't know why, because I'm from there, Cleveland Browns, forgive me.
Thanks, Greg. Gavin.
Hi, everyone. I'm Gavin Stevens, Executive Director with the Alamance Community Foundation over in Burlington. And my husband played for the Elon, so I think that's my team.
All right. Wonderful. Thanks, Gavin. All right, Keith.
Keith Hyatt, I'm a CPA, and with Breslow Starling, I like the Panthers. I'm okay with the Panthers. So thank you.
Terrific. All right, Michelle.
Oh, sorry. Good morning, everyone. I'm Michelle Schneider. I am the Chief Philanthropy Officer for Cone Health. I'm an Eagles fan, and I love the introduction Greg gave about making college more affordable. That was excellent.
Thanks, Michelle. All right, Trey.
Morning, everyone. My name is Trey Erb. I'm a new advisor at Pliedman & Associates here in Greensboro. Favorite football team has got to be for college, the Clemson Tigers, but I'm also a diehard Philadelphia Eagles fan, so it's between those two.
All right, well done. We didn't say you had to choose one, so I'm glad you chose two. Erin.
Hi there, I'm Erin Bailey. I am an estate planning, ERISA, and general tax attorney at Tuggle Duggins. I'm a partner at Tuggle Duggins. Been a lifelong Steelers fan, so slightly disturbed by some of the other teams out there, but they're no Ravens fans, so that's probably all right.
Thank you, Erin. Lindsay.
I'm going to stay on mute because I have a 6-month-old here, but.
Very good. So I'll read Lindsay's for you. She's a wealth advisor at Stearns Financial Group. She's a New York Giants fan. And I'm just reading now, she's listening without a camera on because she's got a 6-month-old. All right, super. Thank you, Lindsay. All right, let's go to Barry Utesh. Hey, Barry.
Hey, good morning. Yeah, Barry Utesh, Total Computer Solutions. I'm a small business owner, and you didn't specify, so go Wolfpack.
All right, wonderful. Thanks, Barry. Glad to have you here. Phelps.
Hey everyone, Phelps Sprinkle, Vice President for Development and Donor Services at the Community Foundation. And since you didn't specify football, I chose the football that I watch, which is soccer in the United States, Tottenham Hotspur over in England.
Very nice, very creative. Love it. All right, Michelle. Oh, she's listening on mute. I'll speak for her. She is the founder of Copper Seed Financial Coaching. And she doesn't watch a lot of football, but she went to school at UVA, and the Saints are her favorite pro team. All right, David Duff.
You're muted, David. Hey, David, you're muted.
I don't even see David anymore. Oh, there you are, David.
Okay, well, I've got two channels going. You may get some feedback. I've got my phone going as well as the video. So anyway, I don't have a favorite football fan, but I'm with the Lincoln Investment here in Greensboro.
Terrific. Thank you, David. All right, Carrie. Well, Carrie, if
Carrie's on the phone. I don't think she can.
Okay.
She's probably driving.
So I will do Carrie's introduction. Carrie Foley is a paraplanner and communications director with Richard Roach Financial, and her favorite team is the Patriots. All right. So did we miss anybody? Linda Erickson, you came in late. Would you do an introduction, your name, role, title, and company and favorite football team?
Good morning, all. Linda Erickson, founding partner, financial advisor with Erickson Advisors. And I don't really do football, but I guess I got to go with Tar Heels because that's where, we've got education roots. Okay.
Well, that sounds good, Linda. Thank you.
And Abby,
Whitman?
Abby, before we move on, we've got I want to shout out to Marion Ragsdale, who's a potential new member. And if she could introduce herself, that would be fabulous.
Terrific.
Hi, good morning. I'm Marion Ragsdale, and I'm on the development team at Habitat for Humanity here in Greensboro. And thanks for having me.
Wonderful.
And I don't have a favorite football team right now either. I'm a tennis fan. Yeah.
Terrific. Do you have a favorite tennis player then?
Absolutely. Who doesn't like Djokovic?
All right. And Linda Whitman, did you want to introduce yourself?
I will. I'm sorry. I am driving. Linda Whitman, partner at Delman and Company CPAs. I'm a CPA. And I am a diehard Denver Bronco fan as I grew up in Colorado. Love my Broncos.
Fantastic. Thank you. It's good to hear your voice, Linda.
I didn't get to tell you about my Stanford University. I was a junior rooter way back. I had a good team way back when Jim Plunkett was a quarterback, way long time ago.
Well, that's exciting, Doug. Thank you. So I'm Abby Donnelly. As I said earlier, I'm the founder of the Leadership and Legacy Group, and we work on the leadership and people side of succession and exit. And my favorite football team has to be the Florida Gators. Woohoo, go Gators. That's where I went to grad school. So those football games are a lot of fun. Well, thank you all for not only being here today, but for sharing a little bit about you. And thanks to Julianne for the creative addition to the introductions. So I'm very excited about the panelists that we have today and the topic that we're going to cover. Philanthropy, as many of you know, is important to business owners, but it often doesn't come up in the flurry of their day-to-day activities. And it also doesn't come up very often in the discussions that we might have with them about succession planning and exit. But what you're going to learn today is that there can be some real strategic advantages if owners can be proactive about their philanthropy and how it might fit into their business now and through their exit. So today we've got a couple of really neat topics we're going to cover. We're going to talk about some strategic leverage points. We're going to talk about how do you talk to your clients about philanthropy's potential benefits. And we're going to share a bunch of tools that you can use for different situations. So as we go along, if you have any questions, please put them in the chat. I'll be monitoring the chat and I'll jump in and try to tee up your question at the right time. I'd like to ask all of you to keep yourselves on mute except for the panelists who will be engaging as we go. And I'm going to start by introducing Phelps, who will then introduce the rest of the panelists. So let me tell you a little bit about Phelps Sprinkle. Phelps is the Vice President, as he said before, of Development and Donor Services at the Community Foundation. He holds the CAP credential, which is the credential that everyone else on the panel also holds. And he's going to tell you a little bit more about that as he gets into his introduction. He will also be facilitating the panelist discussion. So I've known Phelps for a long time and he's terrific. He's a passionate advocate for helping leaders make good decisions around philanthropy. He is also passionate about sharing the power of philanthropy for all of us, whether it's a business owner or not, and supporting philanthropy as a win for an owner, as a win for the nonprofit that's benefiting from that philanthropy, and as a win for the community. So I'm going to turn it over to Phelps, and he's going to get us started. Phelps?
Help Sprinkle. I like that. I might change my name. Thank you, Abby. I appreciate it. And this just seems like a really energetic group. I know it's a very knowledgeable group because I see a lot of people that I know, and really appreciate you guys joining us. If we are going to have questions throughout, but please use your chat function for those if you would. If we have time at the end to do a true Q&A, we will, but I think we're going to try to, we have a lot of material we're going to try to get through and want to make sure we get through it. So Q&A through the chat, if you would, I appreciate that. So we have a distinguished panel today, and let's pull up the slide with the names of everybody on the panel, if you would, Julianne. And by the way, everyone, Julianne and I, if you didn't pick that up or know it, we work together at the Community Foundation, and we lead the CAP program study group, and Julianne is the reason why that is so successful. So here is a list of our panelists. I think, here we go. There it is. And I'm not going to give you a lot of background on each of these people. You may know each of these folks. One of the things that I think is really neat about the CAP program is it attracts people from all over. Erin Bailey, who is an attorney director at Tuggle Duggins and a CAP designee. Erin, will you wave? There she is. And then Keith Hyatt, who many of you guys know from Breslow Starling. He's a CPA and a CAP designation. And then Michelle Schneider, who is a CAP designation, also is Mrs. I call her Mrs. Philanthropy or Miss Philanthropy around Greensboro. Everybody knows Michelle. She's an amazing fundraiser and an advocate for philanthropy as well, and has taught me so much over the years. She's also a former small business owner, and that's going to play into our conversation today. So thank you guys for joining us. So let me start out by telling you a little bit about CAP, because we one of the reasons that Abby was interested in this topic, I think, was because of a conversation that she had had with Julianne actually around what the CAP program is and how relevant it is for business owners in so many ways. And so that piqued Abby's interest, and we started having a conversation, and this panel came together very quickly. But the CAP is a chartered advisor in philanthropy. It's a designation from the American College of Financial Services. When I was looking to join SFSP several years ago, I was talking to Greg about designations you needed to have, because at the time you needed an advanced degree, and I only have a bachelor's degree. So I started looking around and found the CAP program online and went back to him and said, would this suffice? And so he said, well, let me check that out with National. So he called National. And about a week later, he called me and said, I have good news and bad news. The bad news is the CAP is not one of the designations that they've listed, but the good news is you don't have to have any advanced degrees anymore. So if you've got experience, you can kind of join us. So I put it aside for a few days, but it kept nagging at me. So I looked into it more and found that there were other community foundations across the country who had formed study groups where they brought advisors together, wealth advisors, accountants, CPAs, estate planning attorneys, folks from all types of different backgrounds, as well as development folks, and even in some cases, some philanthropists who wanted to expand their knowledge of philanthropy. And they were doing these study groups where people were going online and taking the course and then doing the study group together. And when I talked to the folks at the community foundations, my peers in other cities, these are typically bigger cities at the time, they told me one of the greatest benefits was the networking that happened and the sharing of stories between each other. And I see Michelle and Aaron both nodding. That's been the case when we've done these study groups. So we're happy to tell you more about CAP if you're interested in the future, but what we really wanted to do is share some of the knowledge that we picked up from this class that will be really relevant to you guys. And again, don't hesitate to ask some questions. So let me start out just by saying, Greensboro is a really philanthropic city. And I've just been really amazed in the role that I play at the Community Foundation. I've gotten to talk to a lot of people and see a lot of things around philanthropy. And many of you have been here longer than I have. I'm a native, but I moved back about 8 years ago. And phenomenal place and a lot of opportunity for more philanthropy. And one of the things that got me excited about that was that there's so many people doing giving, but not necessarily in an organized way, and haven't necessarily thought about that in a proactive way and incorporated that into a lot of their strategic planning and how they live their life and how they do things. And so that's another reason why I think this program is so powerful. But a lot of it has to do with changing the conversations. And so what you'll hear a lot today is from folks who are talking about how they're having different conversations with their clients and how they're learning to do that, and want to share that kind of with you all. We thought it'd be fun to start out with a polling question, because there's a lot of statistics in the CAP program that we've learned, some of which were really interesting. So we're going to start out with a poll question. Julianne, do you want to set that up for us? Oh, there it is. Okay. So we're going to have two questions. The first one is, for what percentage of your clients is philanthropy part of the discussion? And if you would answer that real quick, and we'll get an answer back.
For those of you that don't have a checkbox or anything, just click on the word, you'll get your response registered.
I can't see those. Julianne, is it, are they coming to you, or are you able to see the responses? What do you see?
Yeah, I think once we have 65%. I know we have some on the phone, so.
Yeah, actually, if you're listed as a panelist, you won't have the ability to vote.
Okay, so I can end the poll if you like. I think we have all the votes in. Can you see that?
Yes, that's okay. Pretty even distribution.
Mm-hmm.
Okay, great. Let's answer the second question. Put the second question up, and that is, when you talk philanthropy with your client, what percentage of the time do you initiate the conversation? Sorry, I'm moving too fast.
I know. Let's see. I already did that. Stop sharing. Abby, how do I get to the second poll?
If we had a stage, I'd do a little soft shoe for you guys.
Yeah.
You know, while we're waiting, but
You could do some poetry.
No stage necessary. Go right ahead.
actually, I don't know how to do that, but somebody here probably does.
Is it what percentage of time, Julianne?
Yeah. Oh,
Okay,
Abby,
there
we
you go.
can't hear you.
How's that? Can you see that now? Oh, hold on. Let me launch. There you go. How
Okay,
about
there
that?
we go.
That worked.
Perfect. I don't know why I couldn't get to that.
I couldn't either.
So yeah, so when you talk about philanthropy with your client, how often do you initiate the conversation? This is anonymous, remember, so I answer honestly. We'll see if this is consistent with some national statistics.
Okay. All right, I'm gonna close the poll in. There we go, and share it. There we go.
Okay. I initiated most of the time. 1/3 of you said that. Half the time, 42%, and then it's spread out around the rest. I would bet I never initiate is probably someone who may be a specialist in some way, and maybe I always initiate it was Julianne herself, possibly.
No, I can't vote.
I should say, or Michelle. So we wanted to do that because there's some really interesting statistics out there. There is a Bank of America Merrill Lynch study that you guys are probably familiar with from several years ago that we're going to pull up right now and show you the actual statistics from that survey. And the answer that they came up with was it depends on who you ask.
Hold on.
We're going to go back.
Sorry, it's too early.
That's okay. We didn't do a dry run. So
no, there you go.
All right. So it depends on who you ask, right? So the advisors typically say that they initiate. And in this case, it was about half of the advisors said that they initiate, which is actually pretty close to what our folks said. And then the clients said that they initiated. And one of the things, so I think that's pretty telling and pretty interesting because they were polling, the people. It was a sample poll that was a valid poll, and both people kind of felt like they were the ones who brought it up. What I think is really neat about this, and we're dealing about this, is we think there's a real opportunity, and that's why the CAP program I think has been so popular across the country with advisors, is that it really is trying to focus on incorporating philanthropy and giving into your practice and making you a better advocate for your client, for their whole family, for the community, and create deeper relationships for you with your clients. So thank you, Julianne, for running that. You can close out that slide now. So today we're going to cover three kind of main areas, and the first one is the relevance and role of philanthropy to business planning. The second one is some specific techniques that we're going to consider, and then the third is really an emphasis on the importance of collaboration between advisors and the client. That was one of the big takeaways for us. But before we get into that first part, I thought it might be when we were planning this, we were thinking about our backgrounds, and Michelle has a really interesting story that we thought she might share with us and that would get us started off. As I mentioned before, she is a former business owner, not only a leader of philanthropy in Greensboro. So Michelle, will you get us started out?
Sure, thanks, Phelps, and good morning, everyone. I appreciate the opportunity to have this conversation. And I guess I should clarify, I am married to an entrepreneur, and we and another couple owned about 5 businesses over a 25-year period. And some of those were really good to us, and some of those were, you know, epic fails, but that's what entrepreneurs do. What I didn't appreciate until I found myself in this relationship is how much being a business owner really dictates your life, right? It's very different than working for somebody. Every part of our lives was sort of centered around the business. Our schedules, the timing of when we started our family, our cars, our insurance, our paycheck, everything was really related to that, which was a really different experience for me. You know, our 401k, our the lack of funding we had for our college fund for our children. You know, we were funding the businesses, not that. Even my career was really dictated by the success and the current state of the business. You know, I sort of went with the flow with that. So we were very, very fortunate a couple of years ago to be in the positive position to sell the business. And it was something we weren't sure we would be able to do. But what we were, the business was in great shape and there were people who were interested. And so we started that journey, and we had every advisor possible. We had CPAs, several attorneys, a business broker, insurance agents, financial planners, everybody. Like, I didn't really realize what a wonderful team we had amassed. And we went through the process, and what I thought would be a really positive time for us was actually very difficult. It was exciting because we were, you know, we were able to accept that we had been successful and there was something to sell. It was scary because we were redefining ourselves personally. I remember my oldest son said, "Why is dad home all the time now? Like, you know, he hasn't been home for 25 years. What do I do with him?" It was hard. It was really, really hard. And I've told this story before. On the night of closing, we went out to dinner to celebrate, and we ended up taking our meal to go and went home and just felt really emotional and not what I had expected. And so it wasn't until about a year later, and I'm sitting in a CAP class and we're talking about succession planning, we're talking about the sale of business, and literally it was like a light bulb went on for me. And I will tell you, we had wonderful advisors that many of you know, but we gave them the wrong job. We asked them to help us get through this transaction. We did not ask them to help us, you know, redefine who we were going to be as a family, as individuals. And so literally it was not a happy year. And it wasn't until I sat in the CAP class and I was really frustrated with myself, quite honestly, because as a fundraiser, it never dawned on me that our family was going through what was likely the largest single financial transaction we will ever make. And philanthropy never came up. I never brought it up. Our advisors never brought it up. I honestly never even thought about it. I would think about philanthropy during the day as my job, but I never took that home to say, this is our chance. And it's still a chance. Obviously, we still have the opportunity and we do give regularly, but I do feel like we missed an opportunity to do something really special at that time. And so it wasn't until I was in this mixed group of advisors and colleagues that I realized this has got to be about having the right conversation with your advisors, not just getting through the transaction. So I'm excited to be here. In that vein, I'm really excited to be here as somebody who represents philanthropy in our community. And I'm really hopeful that we're going to change the conversations that we have with a lot of the same people we all work with. So that's just a little bit of context. It's a good moment in time to remember that we can change the way we do things for the better. So Phelps, thanks for having me here this morning.
Thank you, Michelle. I appreciate that. I appreciate all that you do for Greensboro. And I know you're such a huge advocate for philanthropy and a partner to so many people. And more of us want to do that with you and other people in the community. I see a couple other people have joined us. JT, John Thomas with Stearns is here, and he is a CAP graduate as well. Thank you. And Vishali Shah, who's a CAP certified. You can ask any of us anytime you want if you want to know more about the program. But thank you all for joining us. So with that, Michelle, let's talk. I'd love to open it up to the panel to talk a little bit about philanthropy, especially around entrepreneurs and business owners with regard to, you know, your personal experience, for example. There's a survey. I didn't pull up any visuals on this, but in 2015, Ernst & Young and Kennesaw State University did a study, and they found that entrepreneurs are the most philanthropic group of people of all the high net worth folks. When they survey high net worth folks, one of the things that they've identified in their most philanthropic subset is entrepreneur business owners. And I thought that was really fascinating. And, you know, you kind of makes you wonder why that might be, but it really makes sense to someone who's probably been there and done that. I myself had a business at one point, and you do feel, you know, you're part of the community. You get to know your customers. You get to know the community. You feel happy that you've had a successful business, hopefully, and have been able to have some success. But I'm sure there's lots and lots more reasons for that. Aaron, Keith, Michelle, would you guys mind talking a little bit then about philanthropy in the community? Around businesses and entrepreneurs, and some of your interactions and the work that you've been doing around that, and what you found to be enlightening.
And this is Erin. So I spend a lot of time speaking with clients on business succession, on estate planning, family planning, kind of what the next generation is. And prior to CAP, I have to say I'm a technical. I could definitely execute what people asked me to execute. From, you know, we wanted a CRUD or CRAD or a, you know, whatever we were looking to do, we could make it happen. But it was less of a strategy or less of a philosophy. And we spend a lot more time now using philanthropy itself as a tool, like the concept of philanthropy as a tool. One of our favorite new aspects is using it as a tool for education for the next generation. We have all these business owners who have been away from home for 25 years, if it heads down, you know, working their butts off, and they look up and they're like, oh wait, I got some kids. Oh wait, I got to, you know, teach the next generation, and they're not ready to take over the business, but they are ready to take baby steps. And philanthropy is this, you know, kind of very safe environment where they don't need to see the whole balance sheet. They don't need to all of a sudden realize that they're worth 10, 20, $30 million. They can just look at a donor advised fund or a private foundation and see that they're able to you know, figure out how do you give, who do you give, making decisions, doing due diligence, looking at investments. And so we really like philanthropy as a tool, and we've gotten better at using it ourselves.
So what's on, you know, I guess that one of the things that you talked about was what's on someone's mind, right? Like, and what I think was really interesting is you talked about the family aspect of it. And I mean, obviously all business owners and entrepreneurs don't have families, or there are quite a few, you know, I've seen some statistics about, you know, how few, it's definitely in the minority of family members, children who want to become part of the family business, if you're looking at the whole swath of that. But oftentimes that is the case. And I know that philanthropy is sometimes having a donor advised fund or a family foundation or even a company foundation where the children can play a part is a way to incorporate and get them engaged and involved in a way that's different from the business itself, because that might not be their thing, but gives them a role and a responsibility. Keith, do you have anything to add to that?
I agree with Aaron 100%. I mean, the idea, it's a mindset change of, I've got many people who every year give to charities, and they're very regular about it, and they don't realize they can have a substantial impact by certain vehicles making an impact that's even greater, 10 times greater than what they've been doing annually. And they don't realize the vehicles through which they can do some of those things. And that's what Aaron, I think, is referencing is just a different mindset of, yeah, I give every year. In fact, anytime a client has an income event, we're talking right now about business owners, but a year where they have a bonus, or they've sold a lot of stock, or they have a spike in income, those people who love to give, there's a real significant way in those years they can, really, from a tax planning perspective, really save themselves a lot of tax as well. But I know that's the mechanical thing. The real thing is, I think, is the planning aspect is
Hey, Phelps, I would add too, when you're talking about entrepreneurs in particular, I've seen a shift in the philanthropy business, so, over a 30-year period, from a language shift that I think speaks to entrepreneurs. We talk a lot more now about investing. We talk a lot more about problem solving or solutions, instead of sort of the softer language that maybe we used before. And I think entrepreneurs tend to have an ability to handle risk in a way that is really necessary on the philanthropy side of things. Like, we don't have the solutions to all the world's problems, but we know we need to try things to get there. And so I think it's really fun to work with entrepreneurs who see they can invest in a potential solution. And that's very different than many, many years ago.
That's a great point from someone who's been in the field for a while too. So thanks, Michelle. Yeah, I mean, I think to Keith's point, he started talking about the how, and the technical pieces of it. And that is typically, Aaron, you said kind of the same thing, is we tend to start with these tools, and we need to be starting with the conversation and asking why, what are you interested in, why, and really getting to the heart of it, and asking probing, open-ended questions, and just learning, being a better listener. I mean, I like to talk, and one of the things I've had to work at the most is learning to become a better listener. And really, I've found when I talk to my clients at the Community Foundation who come and just want to, they've been told, you need to open a donor advised fund, or, you need, they want to talk about their legacy and they want to open a scholarship. I don't say, okay, how do we do that? I used to, but now I say, well, let's talk about what is it you're trying to accomplish. Let's start there. And that has been a huge, I mean, it's so simple to do that, but I wasn't doing it. And part of it was just not having the confidence when I started this, but as I got more confident, it's really fun to have those conversations, and people really appreciate it. So I think that's what one of the huge takeaways for me was how do we have these conversations with people and have the courage to ask them those questions. And I think as advisors, sometimes it can be tough to do that too. But I'm sure many of you do have those types of relationships with your clients. Okay, is anyone anything else pop up for you guys before we move on to the next section? I wanna make sure I'm cognizant of the time so we can get through, because we are going to talk a little bit about techniques and timing and some things to look out for. And we've actually got a slide for this next section of what we're going to talk about. And Julianne, would you mind pulling that up? We gave everybody a preview earlier.
I'm sorry, I'm working on it. I got it.
It's okay. That's all right. No worries.
Here we go.
So on this next slide, you're going to see it's not an exhaustive list by any means, and we're not going to go into detail on every one of these, but we did want to kind of show you and talk about a little bit about some of the specific techniques and tools that we use. Some of these can be very complicated, and there's lots of tax implications and tax laws, and things are possibly going to be changing soon as well that might change some of these. But I think the key takeaway is that there are a lot of different tools that can be used that advisors use. So why don't I open up to the panel, and Aaron and Keith especially, would you guys mind kind of walking us through some of these and talk about these with folks?
Sure. Keith, I'll let you jump in as well. So, the scenario here is we own a business and we are, in this scenario, we're thinking of selling. So either thinking of selling or we just have donative intent. So let's start there. You got to, people always come and say, I just want to save taxes. I want to give to charity. And then you often say, well, what, why, what's your donative intent? So we start with donative intent. We really want to give, we want to do something with it. You don't have to wait until you sell. Often people wait and say, well, not, 10 years from now, I'm going to sell, I'll make my donation then. you can give closely held business stock away during life. It's just you don't get as much bang for your buck. So we're often talking about this prior to a sale. So to summarize, we'll just talk about it prior to a sale. The key there is we're thinking of a sale, and before we sign anything, we're going to give some money to charity. And the overall goal there is just we're going to save some taxes. We're going to ultimately be able to give more money to charity if we give them some of the ownership in the company, other than taking it ourselves, paying taxes, and then giving it to charity. So that's really just from a conceptual idea, is if you give away part of your business prior to sale, that in and of itself kind of gets more bang to the buck for the charity. Some of these other techniques we have in the beginning here are just talking about when the tax laws changed and all of a sudden people stopped itemizing. Just wasn't as interesting. We couldn't quite give enough away. And so what we started thinking about was, how do I still get that tax benefit and benefit the charities I'm looking for? And that's that concept of donor advised funds, bunching your giving. So basically giving enough in 1 year, $50,000 of appreciated, publicly traded stock to a donor advised fund. I don't have to pay taxes on that Apple stock that I, bought for $1. Wouldn't that be nice? And at the same time, I'm going to do it all in 1 year. I'm going to itemize. It makes sense. I get a big deduction. Then I'm going to use that pot over the next 5-10 years to give money away. So that's the concept of how do you bunch up that annual giving so that you can give over a period of time. And then, you also create a plan, right? I'm going to give a big dollar amount, but then I'm not going to have to give away a huge amount all in 1 year, which can be daunting for folks. Keith, I don't want to take up too much here. So any other thoughts on those kind of donor advised techniques?
I think Aaron's right on. Those are great ideas. I think the thing too is, Phelps, you're right. You want to give them the bigger impact, bigger thing, but what really, I think people are tuned to the tax savings. You know what I mean? Unfortunately, that may be triggered. I had a client come in the other day and, who got a big signing bonus, and it's a large amount. And he's an individual who gives every year $20,000, $15,000, $30,000 a year. And every year he's going to give this to a charity that he's really interested in. And I said to him, you're not getting much, as Aaron said, with the standard deduction being where it is, you're not getting much benefit every year tax-wise to your contribution. Wouldn't you want to pre-fund your giving? So especially in a year where you've got this big income event, pre-fund it with a donor advised fund. And he says, wow, I could really do a significant gift and do a lot for my charity. I had never thought about, in other words, then I started talking about, well, what are your donative intent? What do you want to really do long-term with this charity? What is your plan? So what started the conversation, it's kind of the reverse of your idea. I know it'd be nice to come into him and say, hey, what's your plan? What's your goal? But for him, it was the thing that triggered his interest was I can really bunch your giving in 1 year and give you a real tax savings this year in a year when you have a real spike in your income. And oh, by the way, let's talk about what you want to do long-term. And so it kind of goes back to the techniques that now here's some other techniques have you thought about? Not just donor advised fund, but there's other ideas of charitable remainder trusts, gift annuities, other things. If he owns some rental property that that he's been depreciating over the years, and they're very valuable pieces of property. And if he sells them, you're going to have a big gain on the sale of these properties. When you want to eventually get rid of them and not just roll them over to other properties, what are you going to do? What are you going to do when that day comes? And so he says, well, I got some charities that I'm really working with that hey, that's a great idea. I could give those properties to them. And so anyway, just a lot of techniques that open the doorway, and we kind of approached it from a reverse perspective, I guess.
I don't know. Yeah, I don't know if there's a reverse perspective or not, Keith. I think actually probably if I look at the number of donor advised funds, for example, that we open at the Community Foundation each year, the percentage that open in December are is way more than half. And there's a reason for that. That's because people are starting with it, usually typically starting it from a tax perspective, and that's the impetus for it. One of the things, so for us, it typically does start that way. And when we're talking about donor advised funds, we're talking about legacy giving. Typically, it's someone who's already kind of thinking about these things that we're talking about, and we start in a different place, but those happen throughout the year. There's no wrong answer. It's like, do you, when you talk about fundraising, for example, Michelle, I know would say this, if someone wants to give you money for something, their motive for doing so, as long as it's ethical, is not really as important as the gift itself. But when you're talking about long-term, larger estate type giving, you really are talking about the more we get to the bottom of what is it that's driving them, the more likely it is that they're going to really be as fulfilled as we want them to be in their giving. And that's one of the huge things for me. Abby, did you have a point?
Well, I have a question from the chat. Carrie Foley was asking, what do you think holds advisors back from asking those deeper questions about the client's desire to give? And Ben has offered a response to that. I'm interested in whether the panelists have any additional responses.
Yeah. I'll speak from the attorney perspective. I mean, we are very sensitive to the fact that we, bill by the hour. And I mean, I give and I love to give and I love my clients to give, but I also recognize that, if someone comes in and says, here's what I want to do, it's tough to move the conversation along to other options, but we have just internalized and said, we are not doing our job if we don't ask those tougher questions, or just those deeper questions, because you'll ultimately end up with a better plan. You'll end up with a better tax savings, you'll end up with a better plan. To Keith's point, sometimes people just come in and say, I want to no taxes at death, nothing, no taxes. I want to pay no taxes. And they're like, well, spend it, okay, we're done. Great. Whoop, did my job. But often it's just, you have to have those conversations because, so I do think sometimes people think it's not my job. My job is X and they asked for X. And so they wanted a burrito. So I'm giving them a burrito. And understanding that it's really our job to make sure that they, that they really want a burrito, that's really the best option for them, or if there's other options out there. So.
Well, to Michelle, you're to your point about you're selling your business. I'm finding that you need to have discussions earlier on with business owners. I mean, if they say, I'm going to sell my business someday, well, someday might be a year, might be 5 years, might be 10 years, but the sooner you start helping them stage that planning process, whatever their plan is, the better. But you were going to say something, Michelle, sorry.
Well, it's interesting. I just had a thought I haven't had yet. Even within in the philanthropy business, there are different kinds of jobs, right? And some of us are we're responsible for transactions. So we schedule events and we sell tickets, right? That's a very much you buy this and you get that. Some of us are blessed, if you stay with it long enough, to do what we call, major gift work. And it's really different. It's a different part of the process. And it's where we have the blessing of having long conversations in trusting environments with people who want to be philanthropic. So I think this conversation isn't for everybody who's giving, but I think for those people who've made philanthropy a big part of who they are, if we all need to do this. And then I think we need to talk to each other about that. But I do think there's some transaction in our own industry that maybe gives this conversation it makes this conversation challenging at times. So I think about for, CPAs or people who are seeing a client's tax return and you see who they're giving to, I think that's a great way to open the conversation. I see that you give to Habitat. I've been involved myself, because I think, there's a good point here in the chat about if you are philanthropic yourself, that's a different conversation than if you're not. So I think understanding the philanthropy business might help make these conversations a little bit easier.
And then Phelps, I thought I would just kind of go through just to define some of these tools.
That'd be great. Thank you, Erin. Yeah.
So the general concept is prior to sale. So if you're going to sell your business prior to sale, you give a small percentage, usually less than 50%. Most charities don't want more than that, but less than 50% to a public charity. Now you can do it to private foundations again. Don't get as much bang for your buck. There are limits on AGI, your adjusted gross income. There are also limits as to whether you can take a deduction for fair market value or whether you can just take a deduction for basis. And so that general concept is prior to sale, I'm going to donate to a charity, and then miraculously I get a letter of intent, and then I sell my business. It was not intent, we did not know it ahead of time, because otherwise the IRS will collapse your transaction and you won't get that great donation. And then the charity itself does not, because it's a charitable charity, they do not pay the cap gains, they don't pay taxes on that. And so again, you get more bang for your buck for your charity. The charitable remainder, and to be clear, when we talk to entrepreneurs or business owners, that's often where we end up, right? I mean, there are like these other tools, but sometimes we don't need them. So a charitable remainder trust is really a scenario where I'm looking for income during life. And then I need a big deduction today for whatever reason. I need a big deduction today. I need like some type of income stream for life. But at the end, my charity is going to get something kind of at the end. And that's where it's the remainder trust. The charity gets the remainder at the end. That's where you put money or put this entity into this remainder trust income. The income, you're going to get the income, and the charity is going to get the chunk at the end. It's an actuarial nightmare to try to figure out what your donation is, but the goal is have big donation today, give Keith the headache of trying to figure out what that that actual charitable deduction is. That's what a charitable remainder trust. They come in multiple flavors, a unit trust or an annuity trust, but we don't need to get into those details. The charitable gift annuity, that's just a scenario where you are giving something to a charity, typically a public charity, and they are giving you a gift annuity back, right? So you are getting an income stream. There is no gift at the end of the charity. You've already given it to the charity. It's kind of given in exchange. I give you something and you're going to give me this gift annuity. And there are some different tax deduction thresholds for the charitable gift annuity versus charitable remainder trust. And those are just details. I mean, that doesn't really impact. Again, we start with what do we need? Are we looking for a deduction? Are we just looking for donative intent? Are we just looking for an income stream? What kind of tool might make sense? That charitable bailout we left for the end, because I'm pretty sure, Phelps, isn't that how we started this conversation, or this is why we're having this conversation?
That's right, Erin. That's right. Yeah.
Go ahead and tell that. I think that's a really good story of how we got here, and then I'm happy to go into the details on it.
Julianne, why don't you go ahead and start pulling up that slide there? Oh, she's already got it ready. Look at that. So the interesting, so this conversation that Julianne and Abby were having, Abby was familiar with the CAP program and what we were doing and how it worked, and they started talking specifics. And Julianne mentioned this technique that we're going to share with you. And Abby, a light bulb went off, I think, and go ahead, Abby. You say it.
No, I have a couple of clients that are really wrestling, they're philanthropically inclined. They're really wrestling with what to do with their business as they prepare for an exit. And they're not looking to get a big windfall out of the sale of the business. They really want to get some money out of it for sure, but they're not looking for something, substantial as much as they want to take care of their people. And their people that they want to sell the business to don't have a lot of money laying around to buy that business. And so Julianne and I were talking, and she said, well, there's this concept of the charitable bailout. And I said, oh my goodness, that sounds really interesting. Tell me more. And so she started describing it to me. So I'd love for you to take the time, instead of hearing my story, to talk about what it is and how it works.
Well, and I'll just say that when I took the CAP program myself, and it seems like everybody who we've talked to who's gone through that has a star beside this slide, because it is such a really interesting thing that no one really has a lot of experience doing, but it's totally legal and ethical, and we should be looking at this as a tool. So make sure you pay attention to Erin's walk us through this.
So it's interesting. There are lots of different ways or reasons you might actually do this. And so we'll get to some of the benefits at the end. But basically what it means is I own part of a company and I am actually going to give my stock. I'm not actually selling the company right now, but I'm going to give my stock to a charity. And the charity owns it. The charity is the owner of the stock. And, you know, there are potential tax consequences for the charity, depending on the type of entity. But let's just assume the charity only owns it for a short period of time. And then what happens is the company says, hey, I want my stock back. You know, I didn't want Bob to give you the stock. Wait, I want my stock back. So the company, which we all know is actually the owner, so the board member, redeems the stock from the community foundation or from the charity. So essentially it says that retires the stock. The company probably has some cash. Maybe they don't want to make a distribution because they don't want to pay taxes on that distribution. Maybe they have other members. They everybody doesn't need the cash, but they have some cash in the business and they're going to use that cash to redeem the stock. So basically retire the stock. Well, what happens is now all of a sudden I'm the one who donated the stock. My ownership interest goes down. So I'm going to own maybe 50% and maybe now I only own 40%. And maybe my kids had 10% in the business. And now, by the way math works, their percentages have gone up. So I've just gotten a higher percentage to the next generation, but I didn't pay any gift tax, right? I didn't pay any gift tax. I didn't pay any estate tax. They didn't pay anything for the value of their stock to go up. My stock has gone down and, oh, wow, I now have a minority interest. So when I pass away and I leave my stock to my kids, my minority interest is now I get a big discount, and hopefully we keep those. But for right now, I'm going to get a discount at death. And so I've just managed this very elegant solution to my charity has cash, my next generation or other people, it doesn't have to be family, whoever I want, those other members have just, without having to buy anything, without having to use their own money, and without having to have any kind of outlay of cash or taxes, their ownership has gone up. My ownership has gone down. And it's a very interesting and elegant solution for how do I reorganize the ownership table in a company without actually having any kind of transaction. Because any transaction is typically someone's going to have gain, someone's going to have to put some cash on the table or a loan, and then we're going to get into interest rates and other things. It's a really interesting, and so people will do it for different reasons, right? I want to get ownership to the next generation. I want to get ownership to a new class of folks. I want to get stuff to the charity. It can be done in all kinds of ways, but it's really an interesting concept that until you really have it on the table, you might not know all the benefits.
Yeah, and the one of the greatest pieces about this too is there's a giving fund on the back end of this, and that can obviously take many different shapes and sizes. That might be a donor advised fund, but it also could be an endowed fund to support the person's favorite charity, or to support multiple charities in a certain field of interest. There's lots of flexibility in how that person can set up a fund and what they want it to do. But a lot of people that do these types of things, from what I've read, it's really, especially in family businesses, it becomes a part of their focus. Right, it becomes a big part of their civic, of their reputation in the community, of how they are viewed, of how they, are kind of evolving as not just a business, but as an organization that is a big part of the community in the civic sense too, in a formalized kind of way. So, thank you, Aaron, for walking us through that. So I'm looking at the time, and we're actually doing pretty well, I think. So, but I do think we want to move on and talk a little bit more about collaboration, because that's a big part of kind of what I think drives a lot of us, and one of the big aha pieces that came out of some of the CAP work that we've gone through. So one of the, we had one of a very kind of wealthy and former business owner, philanthropist, has been really exposed to here in Greensboro, was exposed to the CAP content. And one of the aha moments for him was that he said, I've got some of the best advisors that money can buy, but I've never had anybody really talk to me as a, quarterback this conversation around philanthropy. No one's ever brought that up. And it dawned on him, that, even though he and his wife are very philanthropic, it wasn't a part of the conversation. And I thought that for me, that was like a huge light bulb, that there's a huge opportunity in this town. If you've got one of our wealthiest folks who's saying that, how many other folks are saying the same thing? So I do think there's a huge opportunity for advisors, and everybody in the room started chumming, licking their lips when he said that. I'm kidding. But again, this win-win-win piece I think is really important. And that's really what I think comes out of what one of the big takeaways we hope you'll get from today. So I thought maybe Aaron and Keith and Michelle, if y'all could talk a little bit maybe about your personal experiences around collaboration, maybe some success, whether they're success stories or missed opportunities, times when you've worked with other advisors, and who's initiated that, whether it's been you or the client, or just some key points that you've learned from the CAP program that you're trying to implement more now.
I'll be glad to start with, my model is the major corporations across America have board of directors, and every company with a board of directors are an outside group of advisors, maybe an inside group of people who tell the company direction, headings, ideas, thoughts, perspectives. And an entrepreneur, the way I look at it, should have a board of advisors as well. Now, it's not maybe an outside board of directors, but have a board of advisors, which includes their attorney, their CPA, an investment advisor, an insurance professional, their banker. And I really feel these individuals need to be talking to each other. As a CPA, there's things I do not know as well as Aaron does from a legal perspective. I'll tell them things maybe that they need to be aware of, but I say, look, you need to talk to your attorney, or investment strategies that make sense, or, other planning, lending issues when it comes from investing or banking. So I really feel like that entrepreneurs, the issue you run into is, who sits where at the table. And I really don't care where I sit at the table. I think the business owner needs to be served, and he or she needs to have that group of advisors who are talking to each other. And what I found a lot of times is get them together for lunch, or get them together for whatever, for a brief period of time, or at least give them permission to talk to each other. I think it's critical. And I've noticed Linda put on the thing, CFPs, yes. CFPs, certified financial planners. The whole group of people who need to be part of that team. I think it's critical.
Do you see, and again, Aaron, I know that one of the points you made earlier was, people are cognizant of, fees. And, obviously that is a really important, and it depends on the profession and how their structure and their business model is behind what they do and all that. Of course, I have I had a 30-minute conversation with a client. I had a 2-minute conversation with a client who we were struggling with kind of an issue, and it became clear that he had 3 or 4 advisors that were advising him. And I just asked the question, are they all talking to each other? And can I talk to any of your advisors? Would you be okay with that? And he said, sure, be happy for you to. And so we had a call with an estate planning attorney, wealth advisor, and the accountant had been on a previous conversation. But we had a conversation about this issue and solved the problem in less than 30 minutes. And it probably cost him less, and there wasn't confusion. I think when emails are going back and forth, sometimes it gets lost in translation. So, I do think there's probably cases where it does cost the client maybe a little bit more, but at the end of the day, if you're getting a more elegant solution that works better in every case, that's probably worth it.
Phelps, one of the biggest complaints we hear in healthcare is my doctors don't talk to each other. You all expect me to talk to the heart specialist and translate to my primary care. And I would agree, we don't do a great job of that. And it's the same analogy, right? They're the patient, they've hired you as the specialist, but they expect you to translate to the other specialist. And we need to just create that kind of dialogue. I would say in my 30 years, I've talked to lots of advisors about account numbers and, you know, how do I get my stock moved over? I can't remember a time where an advisor called and said, I have a client who feels this way about your organization. How can we make that happen? And I personally have felt at times that the gate was sort of up to call and say, your client has had this conversation with me. So I think it's really, I think they expect that of us. I think we would all be serving in our case, the donor, in your case, the client, much better if we, with their permission, you know, come together. But I think it takes a very, a commitment to one another to do that.
Yeah, I also find that, you know, of course we're sensitive about fees, but at the same time, when folks are passionate about something, they just want it done right, and they want it done right the first time. And so if we can just spend, you know, a little bit extra time in the beginning to talk about what those goals are and what we're trying to do. I mean, and I might not be the person to execute it, but the fact that we can identify and the team and who should be doing what, and is it the CPA or us or Michelle, or, you know, who's the right person, then I do agree that ultimately they, you know, they're happier, they have a better product, and then they're a happier client donor, and that's better for the whole team. I mean, we do often, you know, feel like stepping on toes, or, you know, there's the silo or the sandbox, and can we all get along? And once you've worked with folks, which is one of the things I love about CAP, is that you've just kind of broken down some of those barriers in terms of, you know, colleagues and working with folks and getting comfortable, you know, that I'm not just trying to sell a product, and I'm not just trying to, yes, a CRUD, everyone needs a CRUD or a SLAT or whatever, like, and give you another acronym, you need it today, here's your binder. You know, and so recognizing that that's not what we're doing, people are more open to, okay, let's talk about it, you know, let's see what is the right solution. And then it's interesting when we often come back just to the basics. Okay, I you know, here are all these things that we don't need, that we just want to give to the charity, or we just want to give stock early. And so I will answer one question. I think Abby put it in there, and you asked a question, do you have to have a C Corp? The answer is no, but the caveats are, when you're working with S Corps or other entities, you just have to be careful, because there are UBIT, which is, you know, unrelated business income tax issues. You have timing issues. You have to be a qualified entity in order to own S Corp stock. And so any entity other than a C Corp is going to potentially be slightly more difficult. And the only thing that's prohibited is you can't put S Corp stock in a charitable remainder trust. But other than that, nothing else is actually prohibited. It just, you know, sometimes it's complicated, you know, so that redemption is going to be really quick if you're in an S Corp. But other than that, no, nothing's prohibited. So a little technical there.
All right, thanks, Erin. So you know, we've got about 6, 7, 8 minutes left, something like that, and we've covered kind of a lot of ground. I do think we have some time to see if you guys have any key takeaways, things you've heard today, or just pressing questions, or a story of your own that you think is relevant that we could all learn from. Is anyone? We can open the floor up to anyone who has anything they'd like to talk about. This is not a shy crowd, at least not on the chat.
One idea I throw out to everyone, and I know everyone knows this, is that year-end planning is becoming so critical for everyone, and it is the starting point for a lot, like you said, Phelps, where, you know, you have a lot of donor advised funds at year-end, but we encourage people, every one of us should encourage our clients and ourselves personally to do a year-end tax estimate, to look at where we are for the year, to begin to do planning. If we help people, I think part of the process is we help people become more proactive and planning oriented instead of reactive. I think that's half the way to solving this problem. Is, you know, it's terrible in April to find out you owe tax when you could have done something in November or December about it. So if we encourage that, alone might really help spur along this whole planning idea.
You know, Keith, I was thinking about how so many people who are here today are on boards. I'm sure that most of the people here are on one or more boards or have experience with that. And I think about how helpful some of this content has been for me in my civic life too, and I think that's probably true for everybody here. Like, I mean, and not just, to be helpful in the community. That's a part of it, right? It's a win-win. It's also the more knowledgeable I have around philanthropy and the more I'm able to help this charity and help the charity with some of their donors and prospects who are business owners, right? It helps me bring another level of value to that nonprofit. Michelle, Aaron, what about you guys? Any key takeaways or thoughts that you didn't get to express today, or you want to share?
Yeah, the one thing we've talked about as a group that we didn't touch on here is the idea that a lot of these entrepreneurs or business owners, when they make that final transaction, their engagement with the organization tends to become part of who they are, right? So if you've sold your business, you're no longer working 60 hours a week. I mean, the gift of time often goes directly with the gift of finances. And I think that's something that you also can help your clients with, is that transition from, what we've talked about, the transition from success to significance. I mean, I have worked with lots of people who working with our organization has become their next career. And that is a fantastic gift. The nice thing is that the gift that they made, the financial contribution, sort of anchors the relationship, right? Like they've invested, so now they're a part of us. And I think if you could help your clients sort of plan for that in the years, particularly the clients who have a business whose kids don't want it, they've got to redefine themselves. Becoming a part of a charity through their giving and through their time is really a wonderful way to support the community and can be very fulfilling to them.
Kind of adding on to that, we talk a lot about high net worth individuals. And so I think there's a lot of folks who are very successful and doing fine, but they don't consider them, no one ever considers themselves high net worth, even the high net worth. And so recognizing that you don't have to have $5 million in the bank or $20 million in the bank to be charitable and to make an impact, but both on like the actual charities, but also your own and your kids. Having a $25,000 donor advised funds that you talk to your 17-year-old as to, it would be eye-opening, I know, as to what they would be giving to right now versus what I would be giving to, and then being open as a family to kind of work through like, okay, those are goals that you have, your goals, how can we impact the community? And that can be scaled up and down and and one of the things to think about from the folks on the phone is the advisors are often like, are you going to have enough money till 99? You're going to live to 100. Are you going to live to, well, also that answer of you can give today. You don't have to wait till you die. You can give today. You have enough. You can give here. You can give 5,000, give 10,000, because giving away during life makes a personal impact and it's fun. It's way more fun than giving away when you're dead, because you're dead. And so just a huge fan of the advisors not just, hey, you're gonna have enough money to live 100 till you're 110, but you actually have enough money to make some, some contributions today. And it doesn't have to be, $1 million.
So I'm gonna jump in and ask if anyone's got any last comments before we wrap up. Going once, twice. All right, so I want to jump in and thank the panelists so much. Phelps, thank you for emceeing. I'd like to thank Michelle for your wise words from both a leader in philanthropy and a past business owner. Aaron, thank you so much for your insights in from a legal perspective. Keith, thank you so much from a CPA and accounting perspective. And then Julianne, thank you for all the behind the scenes work that you did. It's always a lot harder to do that kind of thing than it is to be sometimes up in front talking. And I'd also like to thank Greg for helping out to get this thing online and moving properly this morning. And last but not least, I want to thank all of the attendees for coming and for participating through the chat and for the introductions at the beginning. I thought this was a fantastic panel. I learned a lot. I took a couple pages worth of notes. And most of all, I think that we all now know not only is it valuable for us to partner together and to create a team to support our clients, but we know now that there are experts out there that are really taking this approach through philanthropy in a new way and are having different kinds of conversations. So I want to thank you all for that perspective as well. And now people know where to find you. We know your name. And of course, if they can't find you directly, you can always come find me and I can get you in touch with any of our panelists and MC. So thank you. And the recording will be available. I'll probably post it on my website if anyone wants to go back and re-listen to any of it, or if you got disconnected like Greg did with a power outage and you might have missed something, you can go back and hear it.